Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will take a look at the markets from the past week. WolfStreet.com founder Wolf Richter talks about the impact of Hurricane Harvey on the auto sector and tells us how to avoid buying a storm-damaged used car. He also compares U.S. housing bubbles to those in Vancouver and Toronto. The Corbett reports James Corbett calls in from Japan and will tell us if a North Korean test missile that overflew that country affected their markets and if people are still getting money out of China despite strong currency controls. Plus, at the end of the show, we'll have a company showcase update with GlancePay.com co-founder Penny Green. We'll talk to Ross Clark right after this.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to the show, Ross, and happy Labor Day.
Yeah, looking forward to this long weekend, both sides of the border.
And for Canadian travelers headed south, good news, the Canadian dollar is where right now?
There's bound to be some good lineups. We've got a Canadian dollar above 80 cents to close off the week, 80.70, best level we've seen on the year. Great GDP numbers coming out on Thursday, good employment numbers. And, you know, it's such that it looks now that the Bank of Canada will probably be doing a quarter-point rate hike here in September rather than in October, November. You know, I think the key here will be that with the strength in the dollar, the Bank of Canada won't be able to do much more than that, but a quarter point seems to be what the street is now talking about for September. And in terms of currencies and looking at the commitment of traders numbers, which were of concern because we have these very, very large speculative positions in the long Canadian dollar, long euro, short U.S. dollars. All those pretty much held their own this week, even though we did have some stability in the currencies early in the week, and then they came with more action at the end of the week. The fact is that if these things do start to reverse, I think we could see fairly large corrections. So with the Canadian up at 80.70, we had been thinking it could make a new high by a cent or maybe 2 cents above the previous high. So we're starting to get into more of that rarefied air again. So I wouldn't look for too much more on the Canadian.
Canadians, though, will end up paying higher gasoline prices all because of Harvey?
Oh, Harvey, you know, here we are. 2 weeks ago, the price of gas in the States, $1.56, ran up to $1.88. This is on the wholesale, just the wholesale price itself. And settled off the week around 178. So that's a 20% move, just related to the shutdown of the refineries and, the crude oil price stuck here in the mid 47 range just because now you've got a glut of the oil that can't move. It'll be interesting to see here in the next couple of weeks when the refineries gear up, and that's minimum of a 2-week process to get them back up and running. What ends up happening with the oil price at that point.
We still haven't seen a big jump in the price of oil. Why is that?
No. Well, you've still got, you know, lots of U.S. supply just keeps coming on stream. They are, you know, one of the world's larger producers now, and there's nothing to slow that down. It's not like the old days when you had to drill and hope that you would find something. Now, if you don't find it right below you, you just start doing a horizontal drill until your fracking does find the oil.
So, in other words, the case is there's lots of oil to be processed. The problem is turning it into gasoline.
That's correct. That's correct. So.
Gold has had a nice rise as well lately. Is that going to continue?
Well, you know, we are in one of the sweet spots for the gold market. It likes to make that July through September move, and you end up with Some key dates as we move through, one being the end of July, which is we did see some strength, which usually becomes the catalyst to take you through August. And when you get to the end of August, that first week of September, so that would be the week we've just finished, when it has follow through, then it's very, very important that it does carry through with some upside momentum. And so far, finishing off this week, we closed up in the 1320 range on gold. Probability of a move through into the month of September is pretty good. But it's when you're breaking out through resistance levels, this is when you have to be most cautious. Most people want to be most bullish at that point, but I always take the cautionary side and say, if it fails here, you have to know where you're going to pull the plug on this. So for us, 1290 now becomes the new line in the sand. I wouldn't want to see the price drop below that as we progress through this month here. Now there was a good increase, another 22,000 in terms of the commitment of traders on spec positions and about 28,000 on the short commercials as of Tuesday. And that's starting to get a little bit pricey. The early part of the move, when we were down in the mid-1200s and started to slowly work its way up, there weren't many speculative positions on at that point, but we're now building it up to the point where it does present vulnerability if there were to be a change, say, in the U.S. dollar index. If the dollar has a good reversal here, tacks on a couple of points, it's around just under 93 on the index. If it were to have a bit of a short covering rally up into maybe the 93.5 to 94 range, that would cause the type of breaking gold that one would want to make sure they don't, that they have pretty tight stops and lock in some of their profits.
Ross, thanks a lot for being on This Week in Money.
Thank you very much.
My guest has been Ross Clark. He's an investment advisor at CIBC Wood Gundy, Vancouver. Coming up, Wolf Richter next on This Week in Money.
Always consult your investment professional before making any investment decision.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Wolf Richter, the founder of wolfstreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money.
Thanks for having me back, Jim.
Hurricane Harvey is going to have an impact on the auto industry. They say a minimum of 500,000 vehicles will be destroyed out of the 5.5 million vehicles that were in the Houston area. But could the damage rate be much higher than that?
Yes, it could be. Nobody really knows at this point what the actual numbers will be. In my article a few days ago, I estimated that 800,000 cars will be flood damaged. And that doesn't mean they're destroyed. It means they have flood damage. And some of those cars will essentially be junk, and they will have to be taken to the salvage yard. Others that are insured, people need to have comprehensive insurance to get flood coverage. And those people that have comprehensive insurance, they'll see the insurance adjuster and they'll write them a check on the spot. And the check will be for the value of an equivalent used car or for the cost to repair it. And And then these people can do, if it's not totaled, these people can do with the car whatever they want. And so they have the money and they have, and they can fix the car. And then there are other people that are not insured and they'll drive it. They'll try to clean it up and fix it and they'll try to drive it. Yeah. So the 800,000 flood damaged cars that I estimated, I figured that only about 300,000 of them would be replaced by new vehicles. And there'll be several 100,000 that will be replaced by used vehicles, and there'll be a few 100,000 that will not be replaced at all, that will just be fixed and driven. Even those cars that will be salvaged, there'll be a whole industry after every major hurricane. You see that. There'll be a whole industry springing up, buying those cars with a salvage title from the insurance companies for next to nothing and fixing them up and selling them. And so, these cars will be around, the ones that can be salvaged, even though they have a salvage title. Now, 300,000 new cars, that was my guesstimate. So if in that affected area, if 300,000 new cars is what it would take to replace it, that would have a significant impact on the auto sector in many ways. Now, because of there's probably 250,000, 300,000 cars on dealer lots in the affected area, and some of those cars are underwater, and they can no longer be sold as new, so the insurance companies will take them off the dealers' hands and they'll enter other channels. And so those dealers with flood damaged cars, they will essentially sit on empty lots, and they have to get new cars before they can sell them. And other dealers on higher ground were able to move the cars out of the danger zone, and so they'll have something to sell. But just to give you an example, in the greater Houston area, last year, the last 12 months, really, there were about 265,000 new vehicles sold. So selling 300 or creating demand for 300,000 new vehicles through a storm on top of the normal demand that you have would put an enormous pressure on absolutely everything down there. You'll have right now the railroads the rail systems are trashed. You can't get through on the roads. The dealers have to bring in those cars. Manufacturers can't ramp up fast enough, so dealers will have to buy from other dealers in the U.S. And Texans don't really like to drive cars, so they want to buy trucks and SUVs. But trucks and SUVs are not. There's not that much inventory problems with them. In the United States, you have a huge inventory problem with cars, but trucks and SUVs not really. So there's not such an excess inventory of those. So trying to get these vehicles in will be a nightmare. And trying to get dealerships back up and running, that will be hard to do. And they'll try everything they can. But I estimated that through the early parts of the first half of September, it will essentially be zero car sales in that area. So starting from late August, from about August 24 through the first half of September, there will essentially be zero car sales and in the entire area. So August will be impacted and September will be impacted. Then dealers are starting to be ready for business again, and they'll sell what they have on the lot and they'll sell what they can bring in, which will not be as much as under normal conditions. So sales will ramp up gradually, and I think this year overall, the sales won't catch up. But if they have to replace 300,000 new units, and that's about how far we're down for the year so far, so compared to last year. So on a nationwide basis, new car sales are down by about 300,000 units. And so if the storm wiped out enough cars to where it creates new demand for 300,000 units, it would just fill the hole that's left behind by the lower demand in the United States right now. But I don't think it will happen this year. It will start this year and it will go into next year. So there'll be more demand next year early on, and then it will eventually wash out. Now, a lot of people say, well, okay, they want to get the homes fixed first and so forth. But people need to understand that in Texas, without a vehicle, you're really screwed. You can't do anything. You can't go to the grocery store. You can't go to work. Distances are huge in cities like Houston. Houston is a vast urban area. People drive long ways to go to work. Mass transit is insufficient, and for most people useless because they live too far away and from the station, and the office is too far away from the other end, and so the first priority will be getting something to drive. So they will make an all-out effort to get their mobility back. And so we'll see that pressure before we see a rebuilding pressure on houses. So I think this will happen pretty quickly, and there will be a relatively strong demand, but it will start later this year. We'll see. Right now, I'm going to summarize. Right now, there'll be zero sales through mid-September, and they'll just gradually pick up. But I think for the year overall, and this area is very big. So if you have zero sales for 3 weeks in an area of this size, it weighs overall in the car sales numbers in the United States. So you'll have a noticeable decline in auto sales in the United States for that period. And I think we'll see the first part of it in August when the numbers come out, and we'll see a bigger part of it in September, and then it will gradually fade out of the system.
Well, could this see an increase in prices across North America as supplies of replacement vehicles dwindle, or is there enough stuff coming out of the factories right now to not really change the price structure?
Well, if Texans were interested in buying cars, everything would be a lot easier because we have a huge amount of excess inventory in the United States. So we're looking at some car lines of 200-day supply. And these cars are sitting on storage lots. They're sitting all over the place. And so dealers who own those cars would love to send them to Texas to get rid of them. But Texas aren't going to buy those cars. They want trucks. They want pickups, and they want SUVs, and they want crossovers. And there will be a shortage. And that shortage will start to appear later this year. And manufacturers will ramp up production, but it takes a while. You can't do that quickly. So I think, especially for certain vehicle lines, you may see that some of the incentives are going away that are now on it, and you may see some dealers less willing to negotiate. Right now, a dealer in Texas, in Houston, who has 20 pickup trucks left that haven't been destroyed, and he has a line of customers waiting out there trying to buy them. I mean, they're not going to get a lot of discounts on those trucks. I mean, that's for sure.
Because right now, I mean, even in Canada, they're offering 25% off on pricey trucks. We could see those incentives disappear as well then.
Yeah, I mean, I see that. I mean, the one example I looked at the other day was a Volvo SUV. It's one of those plush models. They wanted $100,000 for it on the Maroni sticker, and it was discounted by just about 25%. It was a $25,000 discount on that vehicle. Clearly they have trouble selling a $100,000 Volvo, and they may have trouble selling a $75,000 Volvo. But when you talk about work trucks and functional SUVs in the lower price ranges, I think there will be a lot of competition for the few vehicles that will be there.
How can a person avoid buying a flood-damaged vehicle from Hurricane Harvey?
Well, the first thing you do is when you buy a used car, whether you're in a flood zone or whether you're anywhere else, is you check the Carfax. You check the title history to make sure that the title doesn't have a salvage stamp on it. And flood cars that have been totaled by insurance companies and that have been recycled will have a salvage title, so they'll be salvaged or flood marked on the title. So you need to check that. Now, the other thing is that if you buy a used car and the normal price for that used car is $10,000, and you can buy a flood damaged car that looks good and drives well and is okay, then it's okay to actually do that if you get a really big sweetheart deal. The car is worth the regular used car is worth $10,000, and somebody gives you that same car with a flood title, and it looks good and it drives well and it doesn't smell bad, and it's the electronics work and the windows roll up and down, and things like that. And you can pay $3,000 or $4,000 for that same car, or maybe $5,000. I mean, these are really tough to judge. But if you get a huge discount on that car, it may be worth a try. If you have 50% less than the car, if it lasts half as long, you're still okay, And so I'm not saying don't buy any flood cars. If you do, you need to be aware of it, that it's a flood car, and you need to get an enormous sweetheart deal, or else stay away from it.
Will the incentives on 2017 vehicles make it tougher to sell the incoming 2018s?
Normally that's the case, and these new models that come in a staggered fashion. Now we have an oversupply of a lot of cars, so the 2018 models, 2018 models that are coming out are facing the oversupply of 2017 models. Again, I'd like to see the demand from the hurricane area wash out. That's the wrong word to choose here, but for that demand to start entering the equation. And so we'll know a little bit more. I mean, everybody's watching that. When will those cars be replaced? How many of them will be replaced by new vehicles? And of those, most of them will be trucks and SUVs. So there will probably be a lot of demand for trucks and SUVs in the coming months, probably the coming 8-9 months. And so probably we'll see no problem selling 2017 pickups and SUVs. We may see a decline in incentives on those vehicles. We'll probably see every 2018 models getting snapped up of those desirable lines. On the car side, I think it's going to be really tough.
We'll have more with Wolf Richter next on This Week in Money.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Wolf Richter, the founder of wolfstreet.com. Wolf, are any U.S. cities currently experiencing housing bubbles and market tops?
For people who live in Vancouver and in Toronto, probably our housing bubble seems somewhat tame in comparison. But we have a number of cities. And you got to remember, the United States went through a housing bust, unlike Canada, that destroyed a significant part of the value. And for example, in San Francisco, which experienced a phenomenal housing bubble before the financial crisis, prices plunged 43% in the San Francisco metro in the 3 years that followed. So these are big moves down. And now we have seen every one of the top housing markets in the United States, the top 10, has now exceeded the prices of the peak of the prior housing bubble. So, and today people refuse to call it a bubble, but back in the day when the last one blew up, afterwards, the Fed and everybody else said, yeah, that was a housing bubble. It wasn't sustainable, and that's how it goes. And now we're beyond that level in every major city in the United States. And now they're saying, well, no, it's not a bubble, even though the Fed has its eyes on these asset prices and it is worried about them, and that's one of the reasons why they're raising rates and they're unwinding QE. They're going to make that a QE announcement probably in September. But in places like Boston, you're about 20%. Boston might be 10%, 11% above the prior peak. In Seattle, you're 20% above the prior peak. Seattle prices have soared by like 60% since the bottom of the financial crisis. In Denver, house prices are now 43% above the prior peak. And now peak is the time period where people thought it was crazy. Now we're, way above it. In Dallas, it's 42% above the peak. Now, Dallas didn't really go through a major housing bubble during the financial crisis, so they're kind of left out there. But now, since starting in 2012, prices have been shooting up, and there's a phenomenal boom going on, especially in not just in Dallas, but in all of North Texas, up towards Oklahoma and that region. Atlanta has fully recovered. It's now above the prior peak. It got house prices plunged nearly 40%, and it's now recovered above that. Portland prices have soared 71% since the bottom of the housing bust, and so that was 71% in like 4 years. And these are huge price moves. People's wages don't go up by about 1 or 2% a year. So to have housing move like that moves these houses out of range, which is exactly the problem. Houses, when you buy a house for $500,000 and 5 years later it's worth $1 million, it doubled in price. The house didn't get to be twice as large or twice as nice or twice as fancy. You might make some improvements, but the essential house is the same. What changes is the value of the dollar with which you buy that house. And that's why we speak of asset price inflation, because really compared to assets, the value of the dollar has gotten crushed. And that's not just housing, it's stocks, it's every other asset out there. What QE and the interest rates have done is they have created asset price inflation. They haven't created much consumer price inflation, and they've created no wage inflation, but they've created asset price inflation to where, the value of the dollar, depending on where you are and what you buy, may have lost half or more. So, and in some better places, maybe where it's not so bad, the value of the dollar may have only dropped by about 20%. But, you're looking at other places where in a 4-year time period, the dollar has essentially gotten crushed when it comes to asset purchases, which means that the people who make money through their labor, not through capital, but through labor, they see the purchasing power, concerning assets getting crushed. So they cannot buy homes anymore. And when they buy into a pension fund, for example, they will get just a fraction of what they would have gotten before then, and this is the negative effect of asset price inflation. People still make money through labor, and labor has gotten crushed. And that's one of the big issues we have in the U.S. economy right now. That people who don't make money through capital but who make money through labor, that they're being left out of any kind of economic boom. And they're just being pushed further and further into a very difficult situation.
Has the declining U.S. dollar had an effect on housing prices?
In terms of exchange rate, as I just mentioned, the value of the dollar already plunged within the United States with regards to homes. When you talk about exchange rates, so the value of the dollar against the euro or the Canadian dollar or the Chinese yuan, we're in a sort of a new phase. The dollar started rising early this year, and so against the basket of currencies, it's up about 10%. But some of the major home buyers coming from foreign countries are Chinese, and so they're more influenced by the dollar-yuan relationship. And the yuan has risen about 4% so far this year against the dollar, so the dollar has not lost that much value against the Chinese currency. And so 4%, I don't think, and even 10% wouldn't really impact a purchase that is very expensive. I mean, you think about it, but also you look at the trend and think, okay, so the dollar's going to lose more money. If I wait 6 more months, I get another 10% off. And so I don't think that it costs an increase in terms of foreign buying. I don't think it costs an increase in home prices or additional buying pressures. I don't see that. And what I do see is a crackdown in China against capital outflows. So that has started to show up here, and we've seen declining sales volumes. We do see that.
Are mortgage rates likely to head higher in the U.S.?
Yes. That's the short answer. The long answer is they should have headed higher, and they've done the opposite. The Fed started getting serious about rate increases in December last year, and their short-term rates now over 1%, but the mortgage rates have actually come down since then. And so a 30-year fixed-rate mortgage, which is the typical mortgage in the United States, so where you have a mortgage payment that doesn't change for 30 years, those mortgages are still quoted with a rate of under 4% if it's a conforming mortgage, and which means it can be guaranteed by our government-sponsored enterprises. If it's a non-conforming mortgage, it may be slightly above 4%, but these are very, very low mortgage rates. So it's for 30-year fixed-rate mortgage now. So you have a bout of inflation in those 30 years, and investors in these mortgages are going to get hurt. So these are very low rates for terms this long, and in fact they're quite a bit lower. We've had them as high as 4.6%, 4.7%, and they have since plunged. So, but there's usually about a year delay between when the Fed gets serious about changing monetary policy and when it starts impacting the markets in the longer range. I think what the Fed will announce in September, which is the unwind of QE, when they start to roll off the mortgage-backed securities and treasuries from the balance sheet. I think that will have a significant impact on mortgages, but we won't see that happening until sometime next year, when larger quantities of these mortgage-backed securities are starting to come off the balance sheets.
Are banks expanding or contracting credit in the U.S.?
They certainly are trying to expand. In the commercial and industrial loan segment, so there's about $2 trillion worth of these loans out there, and these are loans that companies take out to fund expansion projects and buildings and different things that they do, and equipment, and small companies and large companies. And they have flatlined since last October. And that's very unusual. That usually is a sign of recession. When companies don't borrow money to buy equipment or expand or do the normal business things that companies borrow money for. And these loans are not used for share buybacks. You know, these are loans that are used for collateralized purchases of business expansion projects. And when they flatline like this, it usually means there is a business cycle in place that's turning south. We've seen that time and time again. I don't think there's ever been a period this long over the last 50 years or so since we tracked this number where the CNI loans have not risen without there being a recession. Now, there is no recession in the United States, obviously, but it's not. But businesses are not expanding, and it's not that banks are tightening. Banks want that business at this point, but it's that there's simply no demand. Companies don't need to invest, don't want to invest, or they see that, and they're more interested in buying back their own shares, and also the bond market, bond interest rates, yields are really low, so it's really cheap to issue bonds, and so maybe some of that lending is shifting over that way. At any rate, so on the industrial side, it's flat, nothing is happening. However, on the consumer side, consumers are more indebted than ever. Mortgage loans are up. Car loans have shot through the roof. Student loans are way up. Credit card loans are up. I mean, there's plenty of demand for consumer loans, and the banks are more than willing. They're really eager to do that. I mean, I see ads for 1% down mortgages. I see credit card encouragements and inducements all the time. And the banks are really eager to lend, and there's some tightening on the subprime sector in the cars, in the auto business right now because of the default rates are shooting up, and there's going to be a subprime crisis in the auto sector that's starting to happen. But outside of that, I think banks are eager to lend, even though they may, in the commercial side, they're running into demand problems, and on the subprime auto loan side, they're running into default problems.
Can a president like Mr. Trump engineer a change to the cycle of a market?
Yeah, well, if he doesn't watch out, he might engineer a downward spiral. This market shot up after Trump was elected on the hopes that he would deliver certain things, including tax reform and all kinds of other goodies, and so far none of that has happened. We're supposed to have tax reform already in place in August, and that's there's nothing. And now it's not even tax reform anymore. It's just talking about tax cuts, corporate tax cuts. The reform part is out the window. And there's uncertainty out there. So I think there's a downward risk. If there's a lot of market expectation built into these numbers, and if Trump doesn't deliver, that could be a real disappointment. And that would be a real risk in terms of the near term. I think the next few months we'll see that. Long term, I think the United States will have different issues, but near term, if the market starts figuring out that the promised goodies aren't happening, then probably the marketplace is starting to pull back a little bit.
Will the incentives on 2017 vehicles make it tougher to sell the incoming 2018s?
Normally that's the case, and these new models that come in a staggered fashion. Now we have an oversupply of a lot of cars, so the 2018 models that are coming out are facing the oversupply of 2017 models. Again, I like to see the demand from the hurricane area wash out. That's the wrong word to choose here, but for that demand to start entering the equation. And so we'll know a little bit more. I mean, everybody's watching that. When will those cars be replaced? How many of them will be replaced by new vehicles? And of those, most of them will be trucks and SUVs. So there will probably be a lot of demand for trucks and SUVs in the coming months, probably the coming 8-9 months. And so probably we'll see no problem selling 2017 pickups and SUVs. We may see a decline in incentives on those vehicles. We'll probably see every 2018 models getting snapped up of those desirable lines. On the car side, I think it's going to be really tough.
Will Amazon Whole Foods likely have to lower product quality to be able to lower prices?
People probably going to kill me when I say this, but when it comes to Whole Foods products, Whole Foods has gotten, before Amazon took over, Whole Foods has gotten into very tough competition with other grocery chains. Costco, for example, sells organic peaches by the crate. And the crate is the crate that the grower uses to ship those peaches. So it has the name of the grower on it. And here in San Francisco, I look at the crate, and it's from someplace in California, and I can drive there. I can check out the grower and look at his stuff. And these peaches are a lot cheaper than those organic peaches at Whole Foods, even though they're organic, and even both of them. And with Costco peaches, I know where they're coming from. It's Whole Foods peaches. They're just in a large pile, and I have no clue where they're coming from. So when Amazon is trying to cut prices on these things, it's just trying to bring it up to the same level that Costco and other grocery chains have already lowered the prices to. Now, you can't. I mean, there's cheaper peaches, more expensive peaches, but where Amazon can really affect product quality will be with processed foods, and Whole Foods has a lot of house brands of processed type merchandise, and Amazon can cheapen that, and they can use cheaper ingredients, and they can use lower quality products to make those. I don't know that they will. once Amazon starts doing that, the Whole Foods cachet will completely disappear. And in the end, I don't know that Amazon really wants to maintain the Whole Foods cachet. Amazon's a retailer. They don't really care whether they're just selling to the wealthy or whether they're selling. I mean, they want to sell to everybody. They want to get sales up. So I think they're using Whole Foods as a base, and over time you'll see them become more and more Amazonized, which means they'll have some nice stuff and they'll have cheap stuff, and they'll have all the high-tech processes that Amazon brings to the table, and it will change the way retailing is done. We haven't really seen that much of it. Right now everybody's talking about the price cuts, but I think the technology end of it that Amazon will implement at Whole Foods will probably be the biggest change.
As the internet smartphone era continues to evolve, are we likely to see more closures and bankruptcies for bricks and mortar retail stores?
Yes. I don't think that wave that we have seen over the last 2 years is over. We have some retailers that are in bad shape, like Sears Holding, which is Sears and Kmart stores. They will go under whether or not there's any internet retail. But other retailers are getting hit hard by that shift to the internet, and some of them have responded with very effective internet sites like Macy's and Kmart and Best Buy, and they're able to shift sales from the stores to their own websites, and they have the infrastructure in place to deal with that. So, same-store sales will decline, the profit margins will decline, and Walmart's doing the same thing. I mean, their internet initiative is huge. They're buying companies left and right, internet companies. They're really pursuing that hard, and they're going all out after Amazon. So every company that wants to survive in the United States as a retailer will have to have a vibrant internet presence. And if they can do that, they'll probably keep some stores open long term. There's always a room for brick and mortar retail. People do like to go shopping, and there'll be nice places. There'll be flagship stores. Be in the nice parts where people like to go shopping, and so you'll see that. But the wave of bankruptcies, we just had another one in the United States a couple of days ago, perfume place with chain stores all over the landscape, and this is not going to slow down. We will continue to have bankruptcies until the industry is sufficiently restructured.
After a strong dollar policy during the Obama years, does it look like the U.S. is now focused on a weak dollar policy?
The strong policy, strong dollar policy, it's interesting. Bill Clinton was actually the last president that actually talked about a strong dollar policy. And it's not the president that really manages the dollar. I mean, they talk about it, but they can't actually do much. The manager of the dollar is the Federal Reserve. That's their job, to manage the dollar. And when the Federal Reserve started doing QE in 2008, 2009, and on, anytime you engage in this sort of money printing, it crushes the value of the dollar. And that's exactly what it did. We talked about that a little bit. I mean, there's this internal value where the dollar no longer buys the assets that it used to buy. And then there's the exchange rate value. And in terms of exchange rates, other countries cut their interest rates too, and Japan and Europe engaged in QE. So they responded with similar measures. So the exchange rates really didn't change that much. In terms of dollar, they went up and they went down and they went up and they went down. Since early this year, the dollar has been rising. It's up about 12% against the basket of currencies. And until then, it was actually falling, based on, I'm sorry, the other way around. Since it was rising until the beginning of this year. Since then, it has been falling. Since January, the dollar has lost about 12%. And it's one of, if you look at it on a long-term scale, it looks like a pretty normal trading range. It goes up and it goes down, it goes up and it goes down against other currencies. And so in that respect, I don't think Trump is really changing that much. I mean, right now, for the Trump administration, the weak dollar is very welcome. And Mnuchin today just sort of said, yeah, great, when he was asked about it. And it's welcomed by the Fed. The Fed is raising rates, and it's going to unwind QE, which would normally support the dollar. And if the dollar was sky high, it would be a handicap for them. It would be a reason not to unwind QE and not to raise rates. But now with the dollar being low, they're free to do whatever they want to. And so I think for the Fed, it is welcome also. However, I don't think this is a permanent condition in terms of, for example, the relationship between the dollar and the Canadian dollar or the US dollar and the euro. I think these are just moving in trading ranges as they have done for many, many years.
The Dow reached a number of new highs in 2017. Is this just a reaction to the declining U.S. dollar?
Yes, I think that's where a big part is where the asset price inflation comes in that we were talking about with homes. When it comes to other assets, the same principle played out where it takes more dollars to buy the same thing. When we look at earnings in terms of S&P 500 companies, earnings are used as a rationalization for stock prices going up, but the earnings of the S&P 500 are actually now back where they were about 4 years ago. So, and over the time period, stocks have shot up. So what has happened is that the earnings multiples, the PE ratios have gone up, earnings have stayed kind of flat, and the stock prices have gone up. And in other words, you're not getting more for your money. You're not getting more earnings for the dollar. What you get is you have to pay more dollars for the same amount of earnings. And that's a function of asset price inflation rather than corporate performance. And we have seen this in every other asset class just about. And I think this will continue to play out until we see some decline in that liquidity that's out there. There's an enormous amount of liquidity out there that's looking for a place to go. And because of central bank actions around the world. So, I don't see that happening. I don't see that ending anytime soon.
If the U.S. government fails to raise the debt ceiling by September 29th, what could happen to markets between September 29th and when the debt ceiling is finally raised?
I think the market will ignore a September 29th deadline because everybody knows that kind of deadline that the Treasury announced can be extended. It's sort of a latex deadline, a rubbery deadline. You can stretch it out. It happened with every other debt ceiling issue before. It can go into October, and everybody knows that, counts on it. It probably can go towards the latter part of October. And if the debt ceiling gets raised before the United States defaults on payments it has to make or on its debt, I'm not sure the market will react a lot. I mean, they might get nervous towards the end. Sometime in October, the markets might get nervous when Congress is still 100 miles away from anything. But so far, historically, Congress has always raised the debt ceiling, and everybody is sure that it will. And I'm sure too. I mean, Congress is a political animal, but they're not stupid. And if they don't raise the debt ceiling in time, and the United States has to default on obligations, and that could be salaries and it could be other things, or it has to default on its debt, especially if it has to default on its debt. If it can't redeem the bonds that are maturing, that will be a financial catastrophe, the likes of which we have never seen before. That will be the time to crawl up in a fetal position and wait till the dust settles. That won't happen, but if it happens, if the United States Treasury has to default on its debt and cannot redeem maturing bonds and cannot pay interest on its bonds, I think the financial chaos that will follow will make the financial crisis look tame.
Trump has said he's willing to shut down the government if he doesn't get his wall. How does this play into it?
Government shutdowns are somewhat worrisome, but they're not at the same level as a U.S. default would be. So they'll, like last time when they shut down the government, they'll shut down. They close a lot of symbolic things. So they'll close some national parks and they'll cancel the air shows and different things but the military will keep getting funded and the essential services will keep getting funded and so for many people there'll be inconvenience. Their vacation plans may be screwed up and they may not be able to see and do what they want, but the government will continue to function in the essential services. So I think markets know that, and they expect if a government shutdown happens, they expect that sort of reaction. There'll be prioritization. There'll be some things that will close and the rest will be funded. And so I think that the reaction will be muted. I think there'll be a bigger issue with corporate America. If there's too much uncertainty building up, they will stop hiring. And they will stop gathering cash, and they will stop borrowing, and they will stop making major decisions until there's more clarity. And I think that could trigger some worse economic conditions if companies really get worried and they sort of stop the processes that they have in place now, and that could be a problem.
Is Trump nationalism better for the U.S. than globalism?
When we look at better for something, we always ask who that better is. So better for the United States, better for the economy. So we have to ask who. And when we talk about workers and especially workers, the globalist system we have in place has been very tough on them. It has really it has created essentially an unlimited supply of labor. So labor has lost its negotiating power. Wages have not gone up, and you have a large entity in the United States economy, labor, that has become emasculated, no longer has negotiating powers, and you get to the point, and these are consumers, so laborers are consumers, so that the consumers are not making enough money, and so we'll give them easy loans so they can spend money they don't have to keep the economy going. But for workers, the globalist system has been terrible. On the other hand, for people who are asset holders, for corporations, for homeowners, for many other entities, the globalist system has been very good, and it has increased asset prices. And the consumers too. We have cheaper products because of that. We forget about that. But the fact that a T-shirt now costs $5 instead of $25 is because it's made in Bangladesh with child labor. And so we complain about one part, but we don't complain about the cheap part. And consumers have benefited, but asset holders have benefited the most. So, and that's why you will see a huge amount of resistance against any efforts Trump might put in place to tamp down on the globalist system. And already, all major American corporations are lining up against him on that. Congress is in the pocket of these corporations, so Congress is unlikely to move on this. NAFTA negotiations, you see them going on right now. I mean, Trump's about the only one out there that says, well, I want to pull out if the negotiations don't go right. I mean, NAFTA, the lobbying has started, and these are corporate interest groups on all sides of the border that want NAFTA to be functional and be good and protect their corporate interests. And so Trump is kind of alone. I mean, he needs to tie up with Bernie Sanders in that respect. And in this administration, he doesn't have a lot of support for this. And especially in Congress, this needs to go through Congress too, and Congress is not going to pull out of NAFTA if unless something huge bad happens. So, I don't think Trump by himself can can implement his plan. He needs to have Congress on his side, and he needs to have corporate America on his side, and so far he doesn't on that issue.
Which markets would benefit the most from continued global unrest?
Well, people say gold would benefit the most. I'm not sure about that. Gold goes through very long cycles, and meaning gold cycle can be a decade or longer, So I think we're still in the downtrend of that down cycle that started a few years ago. So there are ups and downs, but it's so far, I don't think that down cycle is over. It's very tough now because just about all asset prices around the world have been overinflated by this monetary policy. So it's very difficult to see which market would actually benefit. It's not like you can pull money out of the stock market and pull in the bond market, for example. I mean, people say this all the time. Well, what happens is when you sell something to pull your money out, somebody else has to pay the exact same amount to buy what you're trying to sell. So nobody can pull any money out of these markets. It just changes the buying pressure and the selling pressure. And so you can't shift money around. You can only shift the pressure around. And so when you try to shift from one market to the next, you'll take the selling pressure to one market and put the buying pressure on another market. The money doesn't really change, So it's hard to say what would benefit. I mean, if there's really a lot of global turmoil, I think what you will see is a global deflation of these asset bubbles that we have, a global asset price deflation. I don't know that there are any good investments left out there.
If China's debt bubble blows up, what effect would that have on the world economy and a nationalist America?
That would be a terrible event if the debt bubble blows up in China. China is a second largest economy. It is immensely linked to the rest of the world, financially as well. Also, but particularly with its trade. It's a huge importer of all kinds of things. Germany and other countries have a trade surplus with China. If the China debt causes financial turmoil, it will not just be in China, it will be globally. And China very well could cause the next financial crisis, and it will be worse than the one we had. China did very well trying to lower the impact of the last financial crisis. They didn't devalue their currency. They kept it stable. They embarked on a huge stimulus program, and they did all these things that helped pull the world economy out of the last financial crisis. But because they did these things, they now have that debt situation where there's $18 trillion worth of corporate debt out there, and a lot of it is going bad. And so the Chinese government is trying to keep this system in place. And they have tools, other countries don't have, because the central bank in China, the Chinese government, and the largest state-owned banks and the largest borrowers, which are state-owned companies, they're all the same entity. So if the government tells the state-owned banks, don't worry about those bad loans, just sweep them under the rug or convert them to equity and forget about them, the banks will do that. And then it can tell the state-owned borrowers, just don't worry about that debt, convert it to equity, keep going, even if you're bankrupt. And so you have total control over the lenders, the borrowers, and the central bank can pick up the debt that's blowing up. The Chinese authorities can control this, and they can probably prevent a big financial crisis. I don't know that they can prevent other crises in their economy, but this kind of financial crisis that we saw, they may be able to prevent. But if they're not able to prevent it, if they do get a financial crisis, I think it'll be a terrible event.
China has instituted currency controls for international purchases by corporations and private citizens. Is this having an effect on countries around the world?
Yes. We have already seen the impact in terms of outbound M&A activity from China. So Chinese companies are trying to buy U.S. or European companies. That outbound M&A activity has plunged. and that includes commercial properties. Chinese entities were big buyers of U.S. commercial properties, and including very expensive buildings and trophy cities like office towers in Manhattan and those kind of things. And that activity has just died. And domestic buyers have already stopped buying commercial, or have stepped back from buying commercial real estate. So there's a lot less transactions going on from domestic buyers. So the Chinese were the last major buyer out there in our big trophy cities, so New York, San Francisco, LA, those places. And so now they've gone, and they're not playing anymore. And transaction volume has plunged. So we'll probably see prices come down too, unless some new investor steps in. We've already seen prices plateauing in the commercial real estate. The M&A activity, when it dies down, is going to impact stocks. So yes, this will have an impact on asset prices. It definitely has an impact on volume and transaction volume. And unless it gives up again, this is a big change. So I think this is one of the things that we'll see. Now, this is something China has to do, because if it didn't do that, if these companies continue to borrow, and these are all debt-funded acquisition binges, if it didn't do that, the financial crisis that they're facing and the debt bubble they're facing would just be completely uncontrollable, and so they have to crack down on these activities, and so it's a good thing. But I think we will see prices follow volume, and volume is plunging, and so it's not very promising.
Wolf, can you tell us a little bit about wolfstreet.com?
Yes, wolfstreet.com is my site that dives into economics and finance. We don't do politics, just finance and economics. I dive into all kinds of details that you might not find in the mainstream media, with lots of charts and all sorts of good things. It is free always, so it's not behind a paywall. Everything's free, and come to wolfstreet.com. We have a very vibrant comment section too. Read the comments. There are often 100 or 200 comments, some of them superb comments, and adding a lot of new data and knowledge to it. So it's a good place to spend some time.
Wolf, thanks a lot for being on This Week in Money.
Thank you, Jim.
We were speaking with Wolf Richter, the founder of wolfstreet.com. He was speaking to us from San Francisco. Coming up, James Corbett reports from Japan, next on This Week in Money.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with James Corbett, publisher of the CorbettReport.com. He's also an editorial writer for the International Forecaster. He's speaking to us from Japan, where he has worked and lived since 2004, originally from Calgary, and still, I would imagine, a Calgary Flames and Stampeders fan as well.
That is correct. Thank you for having me on. Always a pleasure to be here, Jim.
James, did the sirens wail where you live when the North Koreans fired that missile over Hokkaido Island?
I am a good way away from Hokkaido, so it was not that concerning for us individually here, but obviously for the nation of Japan, quite a hair-raising moment. For people who don't know, the North Korean government just recently tested another missile, not an intercontinental ballistic missile at this point, but at any rate, they shot one right over our heads here in Japan, and the path followed it almost passed over the water area right between the main island of Honshu and the northern island of Hokkaido, but I think it went over a little bit of land. But at any rate, definitely passed directly over Japanese airspace, obviously quite concerning on a number of levels, and it did have its effects on the stock market here. You saw a bit of disruption on the Nikkei index as people got a bit spooked, but it seems to have stabilized. In fact, on Wednesday, the Nikkei stock average actually gained 0.74%, and the Nikkei volatility index, the so-called fear gauge, is around 15, which means that people are not quite losing their heads over this. It's not quite causing panic or mayhem, as it seems that despite the provocations and the tests, the possibility of full-fledged military confrontation between U.S. and North Korea still, in the minds of investors at any rate, remains remote. So again, it's quite worrying geopolitically, and there's a lot of geopolitical moves, but economically speaking, it looks like investors are not freaking out about it at this point.
Any impact on the yen?
The yen has not been impacted by that at this point. Again, I think the first order effects we would be seeing would be in the stock market. Secondarily, the yen obviously measured against the dollar really has more to do with the strength or weakness of the dollar than, or the carry trade than it does about the geopolitical move.
Alibaba apparently has found a way to get around Chinese currency controls. How would they do that?
Well, there's a number of different ways that companies of various sorts or even individuals can get around capital controls. And to a certain extent, one wonders if certain loopholes are built into the system, with nudges and winks from Communist Party officials, who have friends in various places. The other aspect to this that we have to keep in mind is that the official numbers and figures that we get from the Chinese government are always, quite suspicious. And a great example of that actually recently came out from a report from Caixin, where they were looking at the official numbers about the outward direct investment of various Chinese companies, and they found that the real estate ODI had dropped 82% year-on-year in the first half of 2017 against the first half of 2016, which sounds like a dramatic drop in overseas real estate investment, until you dig into the numbers and you find that, in fact, a CBRE report shows that Chinese private firm spending on overseas real estate grew 102% year-on-year over that same time period. So how do the official numbers get it so wrong? Well, one of the things that they do not do is take into account money that is Chinese corporations' money that is already overseas and is being transacted in the overseas markets. So all China is putting into their official figures is what is already in China and going out from China. But that's not all the money that's sloshing around in these Chinese firms' bank accounts. So that's one way that these types of things can be gained. And other things are, for example, the way that sovereign wealth funds are tracked versus state-owned enterprises and the different rules that apply to them. So there's a lot of different ways that companies like Alibaba and others can appear, at any rate, in the official figures to be complying with these kinds of capital controls, but in actuality can be moving around overseas holdings and other things that are outside the purview of these numbers.
Are most major Chinese companies part of the government, or the government's a secret partner?
That would be a good way of putting it. Either it is a directly state-owned enterprise outright, or any conglomerate, any corporation of any significant size in China certainly is there by the tacit admission and cooperation of the Chinese Communist Party. There is no major player in the Chinese economy that is not going to be in some way or other beholden to the Chinese government. And if there are players that step outside of the bounds, of course, they do get raided or shut down or thrown in jail or potentially even executed. So I think every major conglomerate and corporation in China understands that, and that's how business is operated there. And that's why you tend to see these large companies, at the very least, have strong connections to the Chinese Communist Party, if not outright having them as investors or secret investors.
Yes, I've covered extradition hearings from people from China charged with corruption, and I asked what went wrong, and they simply said, we bribed the wrong people.
Yeah.
Is China closing down car factories?
Well, they have, there has been a little bit of brouhaha recently, specifically surrounding Hyundai Motors, which of course is a South Korean company, and they have a number of Chinese auto plants, and China has recently moved to close down 4 of them. And it's interesting. For example, the Beijing Hyundai motor is a 50-50 joint venture with BAIC, which is a Chinese automaker, and that was closed down. It has since production has since resumed there, but there was a disruption. And presumably, at least on paper, this is over some non-payment to part suppliers, or something along those lines. But a lot of people are speculating that this actually might have more to do with geopolitics, specifically Beijing trying to bring some pressure to bear on South Korea over the THAAD anti-missile defense system that's just been recently installed in South Korea by the United States as supposedly part of a defense against North Korea. But I think China understands that missile defense system is really aimed more at China. So there's a lot of speculation going on that this may be part of a kind of under-the-cover geopolitical war that's being waged by economic means via China.
I heard a comment that said the U.S., Russia, and China all have to speak with a common voice on North Korea. Is that likely to happen?
Even if it does, that might not actually eventuate into anything tangible. Of course, we know that diplomatic language is one thing, and what actually occurs on the ground is another. And I think a good example of that is China's seeming tacit agreement that perhaps was potentially met at the cake summit with Xi and Trump at Mar-a-Lago earlier this year, where they were enjoying some delicious chocolate cake and discussing things like North Korea. And it seemed at that time that perhaps China had agreed to bring some economic pressure to North Korea over their missile program, but the facts tell a different story. In fact, there's an interesting story up on the Nikkei Asian Review about the economic turnaround in North Korea that has enabled it to aggressively pursue its nuclear development and ICBM development programs, namely that the North Korean Central Bank is estimating, for whatever that's worth, but it is estimating a GDP growth of 3.9% last year, which whether or not it was actually 3.9%, any sort of growth would be a significant change around from 2015, where there was a 1.1% contraction in the North Korean economy. What is this due to? Primarily infrastructure investment, but also mining of coal and lead. And China is a large buyer of coal from North Korea. So it seems that China has been if not bringing economic bear to North Korea, perhaps even actually helping to expand the North Korean economy, which of course helps to, in a sense, subsidize their nuclear development program. So again, whatever lip service is paid to bringing some sort of pressure to bear on North Korea, the actual facts on the ground might tell a different story.
Is there any feeling in Asia that President Trump has surrounded himself with too many generals and that it might affect the way the markets react to the U.S. government?
I'm not sure there's that level of granular detail of analysis in the general press here in Asia, but I think that all of the people who are looking at what's developing in the Trump administration right now are quite concerned about the militaristic tone of this. And of course that goes right from National Security Advisor to obviously the large input that the Defense Secretary and others have had on, for example, the expansion of operations in Afghanistan. So I think that obviously plays into the Asian situation, and Asian political analysts are well aware of that. And that obviously has, again, some pretty worrying concerns for a lot of people about what kind of impact those military counselors will have on the idea of how to resolve the North Korean situation, because obviously military advisors would be more likely to put military options on the table, which I think is what everyone is trying to avoid at this point.
Have India and China called off their border dispute?
In fact, I don't know what the very latest on that is, but I did see a tweet from China Daily, which I did not check out, but they said that there had been rumors that China was going to be paying some sort of money to the Indian government to basically, back down on the Indian border dispute, and China Daily was calling it fake news. So I'm not sure what the very latest on this is, but for people who don't know, yes, China and India have been having some flare-ups over some remote, quote-unquote, parts of their border areas that don't seem like they should be a major geopolitical sticking point, especially now that China and India are more closely related than ever before through organizations like the Shanghai Cooperation Organization, sometimes framed as a kind of counter-NATO organization. India and Pakistan both became full-fledged members earlier this year in this security compact with Beijing. So it seems that in one sense China and India are closer than they've ever been, but at the same time, India has put up a fuss about the Belt and Road Initiative, the Silk Road plan, because it infringes on the Pakistan-India-Kashmir dispute. And also, again, we have border disputes going on directly between China and India now. So it's a very interesting time, and it doesn't look like anything's calming down quite at this moment.
If you look on a map where this conflict is, it is in high mountainous areas where there's nothing but, I guess, snow, ice, rocks, and the occasional yeti.
It's difficult to even find exactly the history of the area and why it's important and what side is claiming what, because there is a bit of a convoluted history to it. The Diplomat has a podcast out that recently went into it in some degree of detail, talking about the historical nature of the dispute. It's not a simple, open and shut, cut and dry thing that's going on here, and it's not immediately apparent to anyone why there'd be any sort of geopolitical utility to this border area. But this is the way these types of disputes often go. It's not necessarily over the parts of the globe that you would first think about when you think about disputes. And it's strange the way this one has escalated so quickly and not gone away. Again, from outsiders' perspective, it might seem that this is such a silly little dispute that it shouldn't be occupying two major powers like this. But in some respects, perhaps this is just a reflection of the fact that China and India, I think, are both respectively very well aware that they are the main competitors for regional dominance going into the future. India has for a long time, of course, as the world's largest democracy, been touted as a rising, developing economic power that has a lot of potential. But I think they realize that China's designs over really South Asia, Central Asia, Eurasia, the entire space, does infringe on India's potential growth. So I think we might be seeing some of that manifesting right now in this border dispute.
James, thank you so much for being on This Week in Money.
Thank you for having me on. Always a pleasure to talk to you.
My guest has been James Corbett, publisher of the CorbettReport.com. He was speaking to us from Japan, where he has worked and lived since 2004. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Wolf Richter, and James Corbett, and thank you for listening. Plus, at the end of today's show, we'll have a company showcase update with GlancePay.com co-founder Penny Green. If you have any questions for the show, you can email us at info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Penny Green. She's the COO and co-founder of GlancePay.com. Welcome back to the show, Penny.
Thanks, Jim. It's great to be here.
I understand you received some pretty exciting news.
Yes. Glance Technologies just announced today a $1 million licensing agreement with a company called ActivePay Distribution. This is a pretty exciting deal because, for obvious reasons, it brings in $1 million in revenue to Glance, but also because it brings Glance into a very exciting and growing market, which is the health and wellness market.
How did investors react to that news?
The reaction today was fantastic. Our stock was up 13% in Canada. We traded over 1.7 million shares in Canada. In the U.S., on the over-the-counter QB, we traded 960,000 shares, and we were up 12%. So very well received was the news today.
Do you think there's a major change happening in how products and services are being sold?
Yes, absolutely. And that's one of the things we're very excited about working with ActivePay. So ActivePay is also the owner of Brazilian Spot, which is a clothing line that imports bodysuits, active bodysuits for working out from Brazil and sells them internationally. And the founder of that company, Isadora Mello, has been very successful in using social media to market her products. She's also a very influential person in social media with over 150,000 followers on her own Instagram and another site which has over 800,000 followers. And so through those sites, has been able to build a network of influencers, and through those influencers, they're able to sell bodysuits and will be able to sell potentially other products. So that's a good example of how products are being sold in this day and age.
Why did you see an opportunity in the health and wellness sector?
Well, it is a very fast-growing industry. The global wellness industry is estimated to be at $3.7 trillion, according to the Global Wellness Institute. And according to womensmarketing.com, that's dominated mostly by beauty and anti-aging product sales, followed by fitness and mind and body exercise, healthy eating, nutrition, and weight loss sales. So these are all multi-billion-dollar industries, and we're seeing a change in how these products and services are getting sold, in that they're really getting sold now through the phone and through social media. So with GlancePay's proprietary system that allows merchants to advertise and receive payments through the app, ActivePay will now have a license to be able to offer all of those features in the fitness and the wellness industries. So the very exciting thing with the founders of ActivePay is that they're leaders in the community. They're both champion bodybuilders. They've won the BC championships in the past few years. And so they're going to be building a network of merchants in these industries, and so that users can go into the app and choose what they want to buy for bodybuilding, for health, for fitness, for beauty. And that is great for Glance because GlancePay has been focused on the restaurant industry, but the technology could work for any industry. So this is a great way for us to get into that sector.
What made ActivePay stand out as a partner for you?
It was really because the founders, they are leaders in the fitness community. Isadora Mello has established herself as an international fitness star, and she has a great following on Instagram, and she also has developed very innovative ways of selling her Brazilian bodysuits, which is also a key component of that company.
Can you tell us a bit more about how you plan to update your licensing strategy?
Yes. What GlancePay has done already is 2 major licensing agreements. So the first one was with Canopy Financial, and it basically allows GlancePay to enter into the very fast-growing cannabis industry through a licensing agreement whereby Glance now owns 45% of Canopy Financial. And Canopy is developing 2 apps for international use. One is a merchant app for anybody in the cannabis industry, and it's so that merchants will be able to accept payments mobile to mobile. And that's using the GlancePay technology. The second app is called Super Dope Delivery, and it's going to allow people to order marijuana on their phone and have it delivered to them. That one is a little bit before its time in that there's very few jurisdictions in the world where that is completely legal on a recreational basis. But the app is being developed, and as different jurisdictions become legal for recreational cannabis, then the app can be used in those jurisdictions. And we're hoping something like that will happen in Canada within the next year. And then for Active Pay, the licensing strategy has been we accept $1 million, and we work with Active Pay to develop out their network. As Active Pay adds merchants to their app and users to their app, those merchants and users will also be part of the Glance Pay app. And at the end of the day, Glance Pay will be the final place where all the transactions are processed.
Penny, for new listeners, can you tell us what exactly Glance Pay is and how it works?
Yes, Glance Pay has developed a proprietary mobile payment system. We spent several years and a lot of money developing it. We've been very successful over the past year since we launched in September 7th in building a network of merchants and users. We're now in 5 provinces across Canada, and we're developing our plans to launch in the U.S.
Penny, where are you traded?
Glance Technologies is traded on the CSE under the symbol GET. That's G-E-T, and it's traded on the OTCQB under the symbol GLNNF, and in Frankfurt under the symbol GJT.
And where can people find out more information about the company?
Go to one of our websites, either glancepay.com or glance.tech.
Penny, thanks a lot for the update.
Thank you.
We've been speaking with Penny Green, COO and co-founder of glancepay.com. We were speaking on August 28th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.